Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at quantum computing.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, please do.
So imagine a company that generates basically the annual revenue of a mildly successful neighborhood coffee shop.
Right, which is not much.
Yeah, not much at all. But then imagine that exact same company is just sitting on a cash pile of over $1.5 billion.
Oh, yeah.
And on top of that, they're actively building a technology that fundamentally defies the traditional laws of physics. I mean, that's the paradox we're unpacking for you today.
It really is a crazy situation because, if you've been following the quantum tech space over the last few years, you probably remember this stock as being just highly speculative.
Oh, totally. A very cash-poor research shop.
Exactly, like the kind of place filled with brilliant scientists and whiteboards everywhere, but, facing a very precarious financial runway.
Right, but that narrative is just completely dead now.
It is entirely dead. We are looking at a fundamental shift here from a theoretical lab curiosity to a heavily funded manufacturing powerhouse.
Yeah.
And when you see a company transform its balance sheet this aggressively, it forces the entire market to just completely reevaluate its potential.
Because the cash they've raised changes the math on their survival.
Exactly. It changes their survival math, but more importantly, it changes their ability to scale.
Which brings us to our mission for you today. We are going to unpack the company's recent, really explosive price action.
Right.
We're going to dissect that staggering billion-dollar-plus war chest. And most crucially, we really need to figure out if their proprietary room-temperature quantum technology actually offers you an asymmetric entry point into this massive convergence of AI and the quantum revolution.
Yeah, and to understand why the stock chart is suddenly waking up, we really have to start with that balance sheet transformation.
For sure.
Because it's the engine driving the entire story right now. Let's look at the revenue trajectory because, well, on the surface, the numbers might actually make you laugh.
They really might. I mean, for the full year of 2025, their total revenue was roughly $682,000.
Yeah.
For a publicly traded tech company with global ambitions, that sounds, virtually non-existent.
It sounds incredibly small in absolute terms.
Yeah.
But if you're investing in early-stage deep tech, you aren't looking at the absolute number. You have to look at the velocity and the composition of that revenue.
Right. The trend.
Exactly. So that revenue figure actually represents an 82% year-over-year increase.
Wow.
But the real signal for you as an investor is beneath that top-line number. They actually saw an over 1,000% surge in their product revenue.
Okay, wait. 1,000% surge is massive. But what does product revenue actually mean in this specific context? Because my understanding is that these early quantum companies usually just do custom research for universities or government agencies.
And that's the trap. That is exactly the trap. Many hardware startups get stuck in what I call the consulting trap.
Oh, interesting.
Yeah, they do bespoke custom services for just a handful of clients. And it brings in cash, sure, but it's fundamentally impossible to scale because every single project is basically built from scratch.
Right, right.
So the shift to product revenue means they executed a critical pivot. They moved away from custom consulting and toward selling actual, standardized, off-the-shelf products.
Ah, okay. So that qualitative shift is the green light. This shows the tech is finally standardized enough to just be put in a box and sold repeatedly.
Yes. But, achieving that standardization requires immense capital, which brings us to the burn rate. And this is where the reality of the hardware business gets pretty brutal.
Oh, yeah.
They reported a net loss of almost $19 million for the full year of 2025.
Which leads to an operating margin that is, honestly, it's comical to look at on a spreadsheet. We are talking about an operating margin of roughly negative 14,000%. Yep. I think when you first see a number like negative 14,000%, your immediate instinct is just to run away screaming.
Oh, it's a shocking percentage, no doubt about it.
But, I like to think of this phase of a company as being like building a massive, sprawling, state-of-the-art automobile factory.
That's a great way to look at it.
Right, because while you are pouring the concrete and you're buying the multi-million-dollar robotic arms and hiring all these engineers, your expenses are just astronomical.
Absolutely.
And because you haven't sold a single car yet, you're profit margins look horrific. Like the math looks terrible right up until the very moment that assembly line finally turns on.
That is the perfect way to frame it. They are incurring heavy research and development costs to build the machine that will eventually build the product.
Exactly.
And the institutional market understands this life cycle, which is frankly the only way you can explain the war chest we mentioned earlier.
Oh, the capital raises.
Yeah. In late 2025 and early 2026, they went out to the markets and raised a staggering $1.5 billion.
Which is just a monumental amount of capital. I mean, it leaves them sitting on $1.52 billion in cash and investments right now.
It's massive.
And here's the kicker. They have a near-zero debt balance sheet, only about $1.8 million in total debt.
Yeah. There's basically a rounding error for them.
Exactly. That gives them a current ratio of over 100. And just for context for the listeners, a normal, healthy industrial company might have a current ratio of 2, meaning they have twice as many short-term assets as short-term liabilities.
Right.
A ratio over 100 isn't just healthy, it is a literal financial fortress.
It completely alters the risk profile of the equity. But it's not just cash sitting in a bank account gathering dust. They also recently acquired Luminar Semiconductor.
Oh, right.
And that changes the cash flow dynamic significantly because it provides an immediate revenue floor. We're looking at an expected $20 to $25 million in annualized revenue from that acquisition alone.
Okay, so that takes us from neighborhood coffee shop numbers to actual, real, sustainable cash generation.
Exactly.
But I do have to push back here for a second, because hardware is a notoriously unforgiving sector.
It is.
Even with that new revenue, they still had a negative operating cash flow of over $30 million last year. So does a $1.5 billion cash buffer truly eliminate the bankruptcy risk that usually just kills these early-stage startups?
Well, I mean, eliminate is a strong word.
Yeah.
But it pushes the risk so far into the future that the market is essentially pricing it out of the near-term equation.
Okay, that makes sense.
Yeah, that cash buys them years of runway. It funds the complete build-out of their next manufacturing facility, Fab 2, without the constant, lingering threat of having to dilute shareholders just to keep the lights on.
Okay, so the cash removes the existential dread.
Yeah.
But nobody gives you $1.5 billion just because you have a nice business plan.
No, definitely not.
You need a revolutionary hook. And that massive capital injection exists specifically to scale a technology that fundamentally breaks the rules of traditional computing.
This is exactly where we transition from the balance sheet to the technological note, because their core technology relies on a proprietary material called thin-film lithium niobate.
Okay.
It sounds like a really dense mouthful of chemistry, I know, but the advantage it creates is basically the holy grail of the industry. It enables quantum processing at room temperature.
Wait, stop right there, because I think we really need to unpack exactly how that works. Why does traditional quantum computing require massive refrigerators in the first place, and how does this lithium niobate stuff actually fix that?
Okay, so think of traditional quantum computers like incredibly fragile glass structures. Companies like IonQ or Rigetti rely on physical matter like trapped ions or superconducting metals to store quantum information.
Okay.
The problem is, physical matter interacts with its environment. If there's any heat, any vibration, any electromagnetic noise, those quantum bits become unstable and essentially shatter. They just lose their data.
Wow. So to stop that from happening, you just have to freeze them.
Exactly. You have to chill them down to near absolute zero. We are talking colder than deep space.
That is wild. It's like having to build a giant industrial meat freezer just to do a math calculation.
It really is. And that cooling requirement completely destroys what the defense and aerospace industries call the SWaP-C profile.
Right.
SWaP-C stands for size, weight, power, and cost. You cannot put a giant cryogenic meat freezer on a communications satellite.
No, obviously not.
You can't put it in a mobile military command center. And frankly, you can barely put it in a modern data center because the power grid is already totally maxed out.
Which brings us back to their breakthrough. So how does thin-film lithium niobate bypass the freezer?
By changing the medium entirely. Instead of using fragile physical matter like ions, their photonic approach uses particles of light.
Light, okay.
Yeah. They fire these photons through the lithium niobate crystal, which acts like an ultra-high-speed microscopic fiber optic highway. And the thing is, light doesn't freeze.
Oh, wow.
Right. Light doesn't care if the room is 72 degrees. By using light instead of matter, the quantum state remains perfectly stable without any refrigeration at all.
That is incredible. Trying to put a traditional quantum computer into a standard server rack is literally like trying to cram an industrial meat freezer inside a smartphone. It's just
Yes.
physically impossible.
Exactly.
But this photonic approach shrinks that entire apparatus down to the size of a standard microchip.
Precisely. And the crazy part is, this isn't just a whiteboard theory anymore. They have a tangible manufacturing moat. The completion of Fab 1 in Tempe, Arizona, makes them the only U.S.-based vertically integrated photonic quantum foundry.
That's a big deal.
It is. Plus, they recently deployed the Dirac-3 quantum optimization machine live on a commercial network.
Now, the science is fascinating, obviously, but here's my question for you. If this room temperature technology is so vastly superior for size, weight, and power, why are the cryogenic competitors the ones building the giant meat freezers winning all the high-profile government contracts right now? Like, is the market just waiting to see if Fab 1 can actually mass-produce these chips?
You've hit on the core tension in the sector, really. It all comes down to how government procurement actually works. Right now, cryogenic systems are the legacy technology.
Okay.
They have a decade of verifiable benchmarks. Agencies like DARPA are incredibly risk-averse. They don't buy the best theoretical technology, they buy what is demonstrable at scale today.
Oh, I see. So they buy the massive freezing computers because they know exactly how they perform, flaws and all?
Yes, exactly. Quantum computing is pioneering a totally disruptive approach here. The deployment of the Dirac-3 proves the physics work outside the lab, sure, but the massive government contracts won't flow until Fab 1 proves manufacturing scalability.
Right.
Can they stamp out thousands of these photonic chips reliably, without defects? That is the milestone the entire industry is waiting for.
And because that milestone is getting closer, the stock chart is really waking up. We're seeing a real decoupling from the broader semiconductor market here.
Oh, absolutely.
Let's look at the momentum and the speculation building right now. In mid-April 2026, shares surged over 11% in a single day, breaking above $8.
And importantly, that wasn't a quiet move. It happened on massive volume,
Right.
Over 20 million shares traded hands.
Wow.
Yeah, when you see volume like that on an 11% intraday move, it means algorithms, institutions, and retail traders are all simultaneously waking up to the story.
But context matters, right? Because despite that violent upward move, the stock is still trading way below its 52-week high of nearly $26.
Right.
So is this what technical analysts would call a bottoming process?
It certainly looks like it.
Yeah.
The long, painful downtrend might finally be reversing, and you can see this reawakening in the auctions market as well.
Really?
Yeah, there is huge speculative interest in near-term call options. Traders are heavily targeting the April 24th $8.50 and $9 calls. People are heavily betting that this upward momentum is going to continue in the very short term.
So what's actually driving that sudden optimism?
Well, a major part of it is the sentiment shift under their new CEO, Dr. Yuping Huang. Analysts have been issuing upgrades specifically highlighting his pivot to photonics.
Go.
Under his leadership, this has really transitioned from a science experiment into a highly credible story stock.
Yeah.
Wall Street finally has a cohesive narrative they can sell to clients.
Okay, yes, the narrative is beautiful right now, but let's pause and look at some data that kind of contradicts that narrative.
Sure.
Because while Wall Street is selling the story, company insiders recently dumped over 1.1 million shares.
There they did.
That is roughly $17 million worth of stock sold right before this big turnaround. I have to ask, is that a glaring red flag? Or is it just normal profit-taking that happens to leave massive room for the smart money to step in?
It's the classic tension of early-stage public companies, honestly. And frankly, insider selling is always a mixed signal. On one hand, yes, seeing executives offload $17 million of stock makes you raise an eyebrow. You want the visionary leaders fully invested in the future.
Absolutely. You want the captain going down with the ship or riding it to the moon?
Yes. But on the other hand, you have to contextualize how these executives actually get paid. They have likely been taking compensation and stock options for years, living on a relatively low cash salary while building the tech.
Oh, that makes sense.
Selling to diversify their personal wealth, or just to cover massive tax bills, is pretty standard practice.
Yeah.
What is arguably much more important for the stock's future velocity is the institutional ownership metric.
Right.
Because right now, institutional ownership is sitting at just over 4%.
4%. That is virtually nothing.
Exactly.
That means the massive mutual funds, the pension funds, the global asset managers, they haven't even really started buying yet.
The smart money has almost zero exposure. As the company hits its manufacturing milestones and as that steady revenue begins to flow from the Luminar acquisition, that 4% could easily scale up to 40%.
Wow.
That represents an enormous wall of incoming capital that hasn't even entered the stock yet.
Which makes the next 3 months an absolute minefield of major catalysts and valuation hurdles.
It really does.
Because retail momentum is building, institutions are waiting in the wings, but we have to do a reality check on the valuation for a second. The stock currently trades at an astronomical 2,387 times sales.
Yeah, that is a multiple that requires a lot of deep breaths. It assumes massive, exponential future growth.
To put that in perspective for you, it's like paying for a sprawling multi-million-dollar mansion when only the concrete foundation has been poured.
Right.
You are paying a premium today for a house you just hope gets built flawlessly tomorrow. With the execution risk looming over the build-out of their next massive facility, Fab 2 isn't a multiple that high, essentially pricing in absolute perfection.
Pretty much.
What happens if the competitors who are currently winning government contracts suddenly solve their own scalability problems first?
It's the primary bear case, and it's highly valid. A multiple of nearly 2,400 times sales leaves zero room for error. If the chip yields at Fab 1 are lower than expected, or if the construction of Fab 2 gets delayed by supply chain issues, the stock could suffer a severe and rapid derating.
Ouch.
This is exactly why the upcoming Q1 2026 earnings report is going to be the critical proving ground.
Oh, everyone is going to be watching that report. We'll be looking for the first real financial contribution from the Luminar integration and vital updates on how heavily Fab 1 is actually being utilized.
Yeah.
And the pressure is on because analysts are projecting an absolutely staggering 3,600% improvement in revenues for 2026.
They have set a phenomenally high bar. But, management isn't just fighting their own internal battles. They have massive macroeconomic tailwinds pushing them forward.
Right, the AI boom.
Exactly.
Yeah.
The biggest theme in the broader market right now is artificial intelligence infrastructure. And AI data centers are physically hitting a wall. They're literally running out of electricity. And traditional electronic chips are melting under the heat of AI workloads.
This is where the physics of light becomes so crucial again. This power crisis creates a macro shift toward optical interconnects, using photonics to move data instead of electricity, because light doesn't generate heat.
Right.
It perfectly aligns with quantum computing's core technology. And I noticed we're seeing this macro interest reflected in the ETF inflows, too.
Oh, definitely.
The Defiance Quantum ETF has been seeing significant fresh capital, and this company is a key holding there. That creates passive, constant buying pressure on the stock.
And beyond the macro trends, there are also the speculative catalysts. I mean, when you have a company with a $1.5 billion cash pile, zero debt, and highly desirable photonic foundry assets sitting in a rapidly consolidating industry, rumors start flying.
Oh, yeah. The M&A chatter is very loud right now. It's unconfirmed, obviously, but it's easy to see why larger defense contractors or massive AI hardware giants might view them as a prime strategic acquisition target.
Absolutely.
But even without a buyout, there is sympathy momentum from government contracts. I saw they recently secured a NASA subcontract. It's tiny, though only about $400,000. Why does the market react to such a small dollar amount?
Because the dollar amount isn't the point at all. The validation is the point. NASA operates in the most extreme environments imaginable. By awarding that subcontract, NASA is actively validating that this room temperature photonic system works where traditional hardware fails.
That makes total sense.
And in a momentum-driven market, that kind of validation can generate an outsized reaction in the stock price.
Okay, so we've covered the physics, the massive cash pile, the insider selling, and the macro AI tailwinds. Let's bring all these complex factors together into a cohesive wealth-building thesis for you. What is the bottom line here?
The final thesis is that the stock earns an 8 out of 10 bullish score. The conviction here is entirely driven by the miraculous balance sheet turnaround and the undeniable physics-breaking potential of their room temperature technology.
Right.
However, that score is kept from being a perfect 10 simply due to the immense execution risk regarding manufacturing scale-up at Fab 2.
But despite that risk, it does offer a truly asymmetric entry point into the quantum and AI revolution. And to understand why, we have to look past the scary valuation headline.
Yes.
Yes, it trades at over 2,000 times sales, but when you look at it on an enterprise value to revenue basis, it actually trades at a discount to its peers. Can you break down why that math works?
Gladly, because this is where a lot of retail investors get totally shaken out.
Yeah.
When you look at a traditional price to sales ratio, it just takes the market cap, the total value of all the shares, and divides it by revenue.
Right.
At 2,400 times, that looks terrifying. But enterprise value is a much smarter metric. It says, okay, if I buy this entire company today, I also get to keep all the cash they hold.
Oh, I see.
So you take their market cap and you subtract that $1.5 billion war chest.
Right.
And once you strip away the cash, you realize the market is valuing the actual core business at a significantly smaller premium than the raw numbers suggest. Because of that bulletproof balance sheet, you are getting the technology at a relative discount.
That is a crucial distinction for your portfolio.
Yeah.
However, you must frame your investment horizon correctly. This is strictly a multi-year hold.
Absolutely.
Do not buy this stock expecting the fundamentals to look radically cheap by next quarter. It is going to take 24 to 36 months for the complete build-out of Fab 2, for the steady revenue recognition from the Luminar acquisition to fully hit the profit and loss statement.
Yeah.
You are buying the foundation, and you have to be patient while the house gets built.
It requires deep patience, but the payoff could be historic if they execute.
Which leaves us with the final forward-looking question for you to ponder long after this talk ends. Think about the massive, crippling power demands of the current artificial intelligence boom.
It's a huge issue.
If this room temperature quantum computing successfully scales, could this photonic technology eventually render today's multi-billion-dollar cooling-dependent traditional data centers entirely obsolete?
It is a question that could entirely redefine the global technology sector over the next decade.
Thank you so much for joining Smart Wealth with Joshua. Stay curious, keep digging into the data, and keep analyzing those catalysts. We'll see you next time.